Did you know that the stock market has crashed more than 30 times in the past century? And yet, some of the world's wealthiest investors got rich during these very downturns. In fact, over 80% of the stock market's long-term gains happened after major crashes. That's right, while most people panic and sell, the smart money knows that recessions can actually be the best time to invest. But here's the kicker: only a small percentage of investors understand how to capitalize on a market in freefall. In this guide, I'll show you how to profit during a recession, even if it feels like the world is falling apart. We'll cover strategies like crash-proofing your portfolio, finding undervalued gems, and making your money work for you while others are running scared. Stay tuned, because what you're about to learn could change the way you think about investing forever. Get ready to turn uncertainty into opportunity. Chapter 1. Crash-proof your portfolio. Strategies for a downturn. When a recession hits, many people panic and sell off their investments. But savvy investors know that downturns often present unique opportunities. The key to surviving, and even thriving, during a market crash is building a crash-proof portfolio. The first step is to focus on sectors that are more resilient to economic downturns. Think utilities, healthcare, and consumer staples. These industries provide goods and services that people need regardless of economic conditions. For example, during the 2008 recession, companies like Walmart and McDonald's continued to perform well. Why? Because even in tough times, people still need to eat and shop for essentials. Diversification is also crucial. By spreading your investments across various asset classes, you reduce your exposure to any single sector's downturn. It's like not putting all your eggs in one basket. According to studies, portfolios with a mix of stocks, bonds, and other assets performed better during recessions. It's not just about having cash or bonds during a downturn. Growth stocks and even international stocks can provide protection. The goal is to balance risk and reward. Another key strategy is looking at dividend-paying stocks. These stocks can provide steady income during periods of market volatility. Companies that pay dividends, such as Johnson & Johnson or Procter & Gamble, tend to be more stable. In fact, over the long term, dividend-paying stocks have outperformed those that don't. According to a study by the National Bureau of Economic Research, dividends have accounted for about 40% of the total return on stocks since 1926. Finally, don't forget about cash. Keeping some cash in reserve, dry powder, allows you to take advantage of opportunities when stocks dip to attractive levels. Remember, being patient during a recession can pay off big time. Warren Buffett once said, "Be fearful when others are greedy and greedy when others are fearful." If you're prepared, a recession can be the perfect time to buy quality stocks at a discount. Chapter 2. The Great Recession Opportunity. Finding undervalued gems during recessions. The stock market often overreacts, causing many strong companies to become undervalued. This presents an opportunity for value investors to pick up gems at bargain prices. The goal is to look for companies that are trading below their intrinsic value, essentially, companies that are on sale. You need to ask yourself, what's the true value of this company, and how does the current price compare? One classic example is the 2008 financial crisis. While many stocks tanked, some, like Apple and Amazon, were undervalued during the panic. If you had bought Apple in 2008, you would have paid under $10 per share. Today, that stock is worth over $170 per share. Apple wasn't a bad company in 2008, it was just being dragged down by the broader market's fear. This is often the case in recessions, where fear leads to overreaction. A great tool for finding undervalued companies is the price-to-earnings (P/E) ratio. A lower P/E ratio can indicate that a stock is undervalued compared to its earnings potential. But remember, this isn't a perfect indicator. It's important to look at the bigger picture. A company with a low P/E ratio may be facing real trouble, so make sure to do your research. Another key factor is a company's debt levels. During a recession, companies with high debt can struggle, especially if they face lower revenues. But companies with low debt are often better positioned to weather economic storms. For example, during the 2020 pandemic, many companies with strong balance sheets, like Microsoft, were able to continue investing in growth, while those with weak balance sheets struggled. It's also wise to focus on companies with strong cash flow. A company that generates consistent cash flow can sustain itself during tough times, while those reliant on borrowed money can falter. The more cash a company has on hand, the more it can invest in opportunities when times are tough. Lastly, don't forget about industries that are counter-cyclical to economic cycles. For instance, discount retailers and repair services often see an uptick in demand during recessions. Identifying these sectors before a downturn can give you an edge. Chapter 3. Survival of the fittest. The buy and hold mindset during chaos. During a recession, emotions can get the best of investors. When the market drops, it's easy to panic and sell. But this is exactly what you want to avoid. The buy and hold mindset is crucial during chaotic times. Instead of reacting to market movements, focus on the long term. Investors who sold during the 2008 crash missed out on the market's recovery. Those who held on to their investments saw their portfolios bounce back, and even reach new highs. Warren Buffett is famous for his buy and hold philosophy. He once said, "Our favorite holding period is forever." By holding on to high-quality investments, you allow time and compounding to work in your favor. While it might be tempting to sell in a downturn, history shows that markets tend to recover over time. The key is to focus on your long-term goals. One important aspect of this strategy is being selective about the stocks you choose. If you're planning to hold for the long term, you need to invest in companies with strong fundamentals, those that can weather a storm. Companies with a proven track record, strong leadership, and a competitive edge are ideal candidates for long-term investing. These businesses can bounce back after a recession and continue to grow. Another aspect of the buy and hold strategy is avoiding market timing. Timing the market perfectly is nearly impossible, even for the experts. The best thing you can do during a downturn is to stick to your strategy and stay invested. Studies have shown that missing just a few of the best performing days in the market can significantly hurt your returns over time. For example, missing the best 10 days of the stock market between 1993 and 2013 would have reduced your return by nearly 50%. Furthermore, recessions often offer some of the best buying opportunities for long-term investors. Stocks are typically cheaper during a downturn, which means you can buy shares at a discount. The key is to remain disciplined and resist the temptation to panic sell when prices drop. Finally, consider reinvesting dividends if you're invested in dividend-paying stocks. Reinvesting dividends during a market downturn allows you to buy more shares at lower prices, which can compound your returns over time. It's like turning a downturn into an opportunity to buy more of your favorite stocks at a discount. By maintaining a calm, long-term focus, you'll be better prepared to profit from a recession rather than get swept up in the chaos. Recessions might be stressful, but they can also be a time to build wealth for the future. Don't forget to subscribe for more tips on recession-proof investing and value strategies that will help you make smarter financial decisions. Chapter 4. Cash is King. Capitalizing on the recession with dry powder. One of the smartest moves you can make during a recession is to have cash on hand, or what's often called dry powder. This doesn't mean you need to hoard cash in a savings account, but rather keep a portion of your portfolio in liquid assets. Why? Because when the market takes a downturn, it creates buying opportunities. Having cash available allows you to act quickly when stocks are trading at discounted prices. During the 2008 financial crisis, the investors who had cash reserves were able to scoop up undervalued stocks. For example, when many banks were on the brink of collapse, Warren Buffett made his famous investment in Goldman Sachs. Buffett's ability to move quickly with cash in hand made him billions. The lesson here is clear: if you wait too long to liquidate assets in a downturn, you may miss the best opportunities. According to a report by Bank of America, recessions often cause panic selling, and the best bargains tend to appear when fear takes over. This is where cash comes in. In a downturn, stocks of solid companies often drop below their intrinsic value due to market sentiment, not because the companies are fundamentally weak. The ability to buy these stocks at low prices can provide huge upside once the market recovers. But how much cash should you keep? It depends on your personal risk tolerance and investment strategy. Many experts suggest having anywhere between 5–20% of your portfolio in cash or cash equivalents. This way, you have the flexibility to buy when the market is low but aren't missing out on returns when the market is climbing. Timing the market is difficult, but having cash gives you the option to buy on dips. You can think of it as a backup plan, allowing you to take advantage of opportunities as they come. A strategy that some investors use is to deploy their cash gradually. Instead of trying to buy everything at once, you can average in, making smaller purchases over a period of time. Additionally, remember that cash isn't just for buying stocks. It can also be useful for paying down high-interest debt or supporting your living expenses in the case of a job loss or income reduction. By securing a strong financial base, you're giving yourself the freedom to take advantage of long-term investment opportunities. By managing your cash wisely during a recession, you can create opportunities for massive returns in the recovery phase. As the saying goes, in a time of crisis, opportunity is born, and cash allows you to seize it when others are fearful. Chapter 5. Contrarian investing. Betting on what everyone else fears. Contrarian investing involves going against the crowd. While everyone else is running for the exits, contrarians are stepping up to buy undervalued assets. This strategy works particularly well during recessions, when fear often causes investors to sell off perfectly good companies. The trick is to buy when others are selling and hold your nerve when others are panicking. Warren Buffett, one of the most successful investors of all time, is a master of this strategy. He famously said, "Be fearful when others are greedy and greedy when others are fearful." This mindset is essential during a recession. When the market is down, and everyone is terrified, that's when great investment opportunities arise. Research supports the idea that buying when others are fearful can lead to above-average returns. A study by Morningstar found that funds that were more willing to buy in down markets outperformed those that tried to avoid risk. Contrarians tend to buy stocks at a steep discount, often in sectors that are temporarily out of favor. Once the market recovers, those stocks can rebound sharply. The trick is knowing which stocks to buy. A strong contrarian investor looks for companies with strong balance sheets, solid cash flow, and a competitive advantage. They are looking for companies that are temporarily undervalued due to short-term issues but have a strong long-term outlook. For example, during the early stages of the COVID-19 pandemic, travel stocks like Delta and Carnival Cruises saw huge drops. But savvy contrarians saw these as temporary dips and made huge profits when the travel sector rebounded. Contrarian investing isn't about being reckless. It's about conducting thorough research and having the patience to ride out short-term volatility. It's a long-term game, and those who play it correctly can come out ahead. While it can be tempting to follow the herd and avoid investing during a recession, contrarian investors know that the real wealth is made during times of crisis. The next time the market is in turmoil, consider whether you're ready to take the plunge and bet on what everyone else fears. Chapter 6. Riding the recovery wave. How to exit like a pro once the market starts to recover after a recession. Many investors face the challenge of knowing when to exit. Too often, investors are too quick to sell after a market rebound, locking in gains too early. But riding the recovery wave requires a strategy. Knowing when to sell is just as important as knowing when to buy. During the 2008 financial crisis, many investors who sold in the panic stages missed out on massive gains as the market recovered. The S&P 500, for instance, increased by over 300% from its 2009 lows to its pre-pandemic highs. The key to riding the recovery wave is understanding the stages of the market cycle. After the initial panic selling, the market typically enters a relief rally phase where investors return to the market, but there's still a lot of uncertainty. This is often a time when some stocks surge. As the recovery continues, investors need to be mindful of valuations. By this point, some stocks may have already regained their losses, while others are still lagging behind. This is where taking profits comes into play. Selling at the right time involves watching for signs of overvaluation, when stock prices no longer match the underlying fundamentals. Make sure to subscribe for more strategies on how to make the most of market recoveries and how to time your exit to maximize profits.